ETF investing never stops evolving and now goes far beyond passively tracking index returns. Find out how our active fixed income ETFs, backed by deep research from Manulife Investment Management, can help you be better prepared for whatever lies ahead. Learn more at jhinvestments.com/ETF.
This is Exchange Traded Fridays, brought to you by ETF.com. I'm Sumit Roy, Senior Analyst here at ETF.com, and I'd like to welcome you to our new and improved podcast. As some of you might know, we took a month off to refresh this podcast in order to make it more engaging, timely, and interesting for you, our valuable listener. Don't worry, we're still going to be having discussions with experts and thought leaders in the ETF industry, but you're also going to be hearing a lot more from ETF.com's editorial staff as well. So on tap today are three topics. We're going to be talking about ETF flows, BlackRock's big bond milestone, and the state of the markets as we head into the rockiest part of the year. With me today to discuss it all is Editor-in-Chief Kristen Myers, Wealth Management Editor Jeff Benjamin, and Research Lead Kent Tooney. Hey guys, how y'all doing?
Hey, Sumit.
Hey, Sumit, how you doing, buddy?
Doing well.
Great to have you all here with me. I think a great place for us to start today is with flows. Obviously, this is an area that we track very closely. I mean, we got articles on daily, weekly, and monthly flows. And we have a very powerful flows tool on our website as well. If you haven't already played around with that, be sure to do that. It's on ETF.com. Now, this is a great time to talk about flows because for the first time in a few years, it looks like ETF inflows could hit record levels. Earlier this week, I wrote about how year-to-date inflows for all ETFs hit about $600 billion as of the end of August. And if you do the math, that puts us on a roughly $75 billion a month rate, or $900 billion for the full year if you extrapolate it out. Now, let's put that $900 billion in context. It's about 50% more than the roughly $600 billion of inflows we saw in 2023 as well as 2022. And it's equal to the current annual record from 2021, which was also around 900 billion. So it's a lot. And there's always a chance that inflows could pick up as we move through the rest of the year. And then we could be talking about a number closer to $1 trillion. Anyway, to me, this signals that, ETFs continue to be a powerhouse and the preferred investment vehicle for people looking to invest and to get access to financial markets. I want to get a little bit deeper into the numbers in a second, but let me ask you guys first. Do you think inflows are going to hit $1 trillion?
We were obviously chatting about this just yesterday, and I was taking the more pessimistic side. But I have to say, I think looking at the numbers just even a little bit more, I do think this might be the year that we do top that 1 trillion mark. So I'm switching teams. I'm going to be joining Jeff. Jeff yesterday, as we were kind of arguing about it a little bit, Jeff very much was bullish on us hitting 1 trillion. So I'm now joining Jeff Benjamin's team and the Jeff camp and the 1 trillion camp. And I think we're definitely going to hit it.
I think that means that I win twice, Kristen, because not only did I sway you over to my side without really doing anything, but I think there was a dinner wagered. So
there was, and I will take you to dinner now. You don't even have to hit we'll still see at the end of the year, but
okay.
you do win. Jeff was able
All
to.
right. No, I say bet the over on this one. This is you've got so much momentum. We talked a little bit yesterday, last time we spoke as a group here. We were talking about some of the potential hiccups, more volatility. This is kind of a crappy time of the year for the equity markets historically. There's this unprecedented election coming up. But my thinking is there's an upward bias in the markets. The pullbacks and glitches we've had so far this year have been essentially shrugged off. The Fed's getting ready to cut rates. They've got to cut rates at least once this year. maybe twice. Those are all things that are bullish for stocks and bonds, and that draws money in. Plus, there's the all powerful financial advisor market, which loves ETFs, and institutional investors continue to come on board. $1 trillion is, I think, in the cards.
I can second that as well. There's a lot of cash on the sidelines, so to speak. And I think if there's going to be money movement out of ETFs, it might be more of a rotation where it doesn't really become a net negative for flows. But the net positive, I believe, that could push us over the trillion will be moving money from cash. Investors have enjoyed high yields on a lot of money market funds or even short-term treasuries, but I think that a lot of that money that's going to push us over the trillion mark is going to be coming out of cash and into fixed income ETFs as those yields fall, and they'll be more attractive coming into those bond ETFs.
Yeah, so Ken, talking about that cash hoard, it was about $6 trillion to start off the year. And, I've had this kind of conversation before with investment strategists and analysts before, and they've really pointed at that cash hoard as being something that we're going to be seeing fueling markets higher, especially into 2025. And so, I mean, again, $6 trillion, then again, that was about 9 months ago. So I'm sure some of that cash has actually come into the market since. But that's a huge amount of money that investors are essentially sitting on, and they're going to want a place for it to really kind of get to work. But I think, Sumit, maybe we should talk a little bit about exactly where some of these fund flows or where these inflows are really going, because I think it's pretty interesting, and I think really speaks to kind of the investor mindset at this time of year right now.
Yeah, absolutely. And it looks like actually the money is headed everywhere, right? If we into the numbers, a few things stand out to me. And one is obviously the rise of active ETFs. We've talked about this a lot on ETF.com. And the fact is that even though they only account for roughly 8% of US listed ETF assets, active ETFs have seen 28% of this year's inflows. So this is a tremendous growth area for ETFs. ETFs used to be, synonymous with index strategies, but now we're seeing active ETFs become a force of their own. Another area we're seeing strong demand is obviously US equity ETFs. And this is the area that's seeing the largest inflows, $335 billion year to date. And that's followed by US fixed income ETFs with $148 billion. But a little more interesting is the fact that international ETFs are seeing some pretty solid demand as well. Those don't get quite as much attention, but we're seeing $56 billion of year-to-date inflows for international stock ETFs and $40 billion of year-to-date inflows for international fixed income ETFs. So, this is an area to keep an eye on. We've seen headlines associated with Japan and the UK and things like that. So investors seem to be gravitating towards, some of these international ETFs. Now, of course, we can sit here and slice and dice these numbers a million different ways, and we're going to be talking a lot more about flows in future episodes, but I'll throw it back to you guys. Does anything stand out when you look deeper into the flows numbers?
Yeah, and so I kind of just want to, again, give a quick shout out to you, Sumit, and another plug again for this work that you've done. I mean, just kind of, again, really reiterating here, you talk about this in a whole article that you wrote on September 3rd. So for all the listeners, please go check out that article. We have a couple of really interesting charts in here. What actually is standing out to me, you kind of mentioned some of those top gainers. Again, the fixed income, those bond ETFs. We're also seeing those equity ETFs. Even if we're looking at year to date, BlackRock's iShares Bitcoin Trust being one of the top gainers. It's actually the fourth largest gainer for the year, at least when it comes to those inflows. But I actually think that some of the interesting stuff actually comes in some of the biggest losers for the month of August. Looking at right now, IWM, that's the iShares Russell 2000 ETF, of course, coming in from BlackRock. It is actually one of the top losers, I would say, for the month of August. Now, remember just a couple of weeks ago or a couple months ago, how much people were interested in those small and mid caps as we were starting to see equities get really, really shaky. And now, again, investors are turning their attention away from that. And again, as you're mentioning, Sumit, kind of going back into some of those equity ETFs, but probably looking at some of those bigger names. And again, I think what's really interesting here, and we're going to talk about it in just a second, but again, this interest in treasuries and in fixed income ETFs, and particularly when it comes to treasuries, looking more at the longer term treasuries and really ditching some of these short-term treasury bond ETFs that we're seeing. We're also seeing some big outflows when it comes to those at least 1 to 3 year treasury bond ETFs, because again, I mean, we can't ignore the macroeconomic picture that we're looking at here that's really kind of driving some of these investor decisions in and out of some of these funds.
Great points. And, we've been talking about fixed income a lot so far in this podcast. You recently wrote a great story, Jeff, about how BlackRock surpassed this big bond milestone. Can you talk a little bit about that?
Yeah, that's really kind of a bonds are back story. I know that anybody in the fixed income space, $140 trillion space, probably thinks bonds never left. But remember, there was an ugly stretch in 2022 when bonds went down in correlation with equities, and then there was the test in early 2020, going back a little further, when the early months of the COVID pandemic, when there was a lot of turmoil in the fixed income space, and institutional investors realized that if they really needed liquidity, they had to go to the ETF space. And that's all kind of leading to what we're talking about with BlackRock. BlackRock, at the end of August, I think, surpassed the $1 trillion mark in their global bond ETF footprint. For context, the entire global bond ETF space is around 2.5 billion. US BlackRock has over 700 billion in global bond ETFs. And so the point, did I say trillion or billion? I meant to hit the $1 trillion mark. The global bond ETFs are 2.5 trillion and so forth. But anyway, the point is that these bonds, the global bond market is picking up, and in part of the global bond ETF space is picking up, and part of that traction is being driven by institutional investors, by financial advisors, and by the inevitable Fed rate cut that we talked about a minute ago. This is, as Kent mentioned, there's a lot of money sitting on the sidelines, sitting comfortably, getting close to 5% in money markets, even in short-term fixed income ETFs. That's all going to keep moving out on the yield curve, moving out in duration to take advantage of the Fed moves. And it's, the Fed's not supposed to cut at least the first time until for a couple of weeks, but you got to be ahead of that stuff. I want to bring in Kent to kind of talk about that a little bit, because that's of the two biggest bond fund ETFs in terms of inflows this year. AGG, the broad market US core, is I think 15 billion, but TLT, the 20-year treasury, is at almost 11 billion in inflows this year. And Kent and I, we talk a lot about TLT personally and professionally. We don't always agree on the right time to buy that, but Kent, it seems like now would be the right time to move into something like that, correct?
I agree. And Jeff, as you're talking, talking about institutional side and investment advisors, I'm an advisor myself, but as much as it seems like I'm a buyer and shareholder of TLT, I write on it mainly because of the story that it tells. And we saw a lot of inflows coming into TLT last year, and I think those are traders that were a little bit too far ahead of interest rates falling. I mean, I believe that this recession, or if we ever get one, has been called the most predicted recession ever. But it still hasn't come. But I think now that the futures market 100% odds of a rate cut coming right in about 2 weeks. And I think that the institutional side, they're putting more money into say AGG than TLT, because now they're saying, okay, this is almost a sure thing. So now is a good time to move our client assets into fixed income, and AGG is just a good total bond market ETF to do that.
Right. And TLT, that's the one that you and I talk about a lot. I think about that, people have been moving in, moving out, moving in anticipation of taking advantage of rate cuts that are going to benefit bonds down the curve. But to me, when I think of TLT over the past couple of years, I think about that cool line from from Michael Lewis's book, The Big Short, where these boss is getting on his trader for, I guess, betting one way or another against the mortgage market, and the trader who messed up, he's like, I wasn't wrong, I was just early. And his boss says, it's the same thing. I love that. Yeah, it is. Being
Yeah.
early is the same thing as being wrong when you're talking about something like this. But anyway, I think the bond space is going to, the bond ETF space is going to get a lot more interesting, and it's definitely something to keep an eye on. That's kind of where all the fun is. It wasn't that long ago that people were saying and writing stories, including myself, saying, what's the point of having fixed income in a portfolio when you're not going to get the ballast and you're just going to give up income because you can get income elsewhere. If you're a longer term investor, just ride the cheap equity markets. But yeah, it's now that's the worm has turned. Things are starting to look a lot more attractive in the fixed income space, I think.
So wait, Jeff, does that mean you're going to go and buy TLT or at least AGG?
Yeah, I'm not waving the banner. I think everybody knows I'm not a big fan of TLT, but I'm not saying, you shouldn't have some fixed income. I know maybe my financial advisor says I should have more than I have, but I do have some.
So speaking, actually, I kind of just want to give some numbers here because I decided to pull up the fund flows pages on ETF.com for both TLT and AGG. Again, these are both two of the biggest BlackRock fixed income ETFs. So to your point, Kent, about people piling into AGG more, you are absolutely correct. Net flows for the year, 15 billion, compared to for TLT, $11.3 billion. Again, this is year to date for those net inflows. Now, we have seen an extreme acceleration in some of those inflows literally within just the last couple of months. I mean, of the 11 billion, I think I just said, yeah, 11.3 billion for TLT for those inflows, 10.9 of them for those net inflows come in just the last 3 months. And then skipping over to AGG, again, year to date, 15 billion in inflows. But we're actually seeing in the last 6 months, again, this is a total bond fund there instead of just a 20 plus year like you have on TLT. Most of those flows are coming in the last 6 months. Of course, again, we're only in the ninth month, so that makes obvious sense. But interesting here that we're seeing such an acceleration into fixed income because, again, at the beginning of the year, if we all remember, if you looked at the performance chart, especially on TLT, it looked like a roller coaster ride. I mean, I can't imagine that those investors were having any kind of fun in January, February, and March. But again, those bond investors really, I think, going to have, I don't know if I want to call it the last laugh, but definitely at least in the next 2 weeks here, as we have these Fed rate cuts and we're expected possibly to have a second before the end of the year, I think we're going to see a nice upward tilt here, particularly for those fixed income investors.
Yeah, and I don't think that's a coincidence because if you recall, January, February, March, we got 3 inflation readings, the CPI numbers that came in higher than expected. And all of a sudden in April, I think people were talking about whether the Fed was going to hike interest rates again. And turns out that was the bottom for the bond market. And that was a great time to get into TLT and ETFs like that. So it's funny how that works, but it certainly seems like the flows in this case have followed the performance. As soon as bond prices bottomed out and inflation, fears were kind of reaching their peak, that's when the flows into bond ETFs began. And as we all know, now inflation is not as much of a concern. It's suddenly concerns about growth and the job market, which I think we're going to talk about now, right, Kristen?
No, absolutely. And just as a kind of really final point on this, just for anyone who's still out here maybe unconvinced, and not to say that we're pushing, we're not fixed income pushers here at ETF.com, but I mean, some of these numbers are really truly hard to ignore. I mean, year to date performance wise for both TLT and AGG, for TLT it's 1.5%. I'm using the comparison tool here right now just to kind of pull up these numbers at a glance. 3.5%, just over 3.5% for AGG. But then when you look at the 3-month performance on TLT, guys, it is almost 8%. And nearly 5% for AGG. So, I mean, these are numbers that you really truly can't ignore. And again, as we're talking about this, these are numbers that are only going to likely accelerate towards the end of the year, especially as we continue to see this rocky economic picture coming out ahead. There's a couple of things that we do have coming. We've mentioned the Fed rate cuts. We do have politics. Now, as we know, markets tend to look past elections, but I feel like there has been some trading around headlines lately. And then, of course, we have the whispers of recession, I think, starting to crop up again, and people starting to get really concerned about growing economic growth, but growing a growth that is starting to slow down. And as a result, we are starting to see now the defensive trade, as I'm calling it, really kind of bubble up again. Now Kent very kindly wrote down all the bullet points of some of these numbers. So I kind of just want to read them out for everyone. So utilities, XLU, that's the Utility Select Sector Spider ETF, that jumped about 5% in August. It's up over 22%, guys, year to date. Looking over, of course, at another, I would say, defensive favorite, that's going to be the Consumer Staples Spider ETF. That's XLP. That jumped 6% in August, and it's up 16% year to date. Now, you want to compare this to a broad market fund like SPY, that's the Spider S&P 500 ETF trust. I mean, the gains in August there, guys, were literally roughly half of what we're seeing in both XLU and XLP. Only 2.3% gain in August, and it is up just under 20% for the year. So we are really starting to see, folks, we talk about this barbell effect, right, in portfolios. And it's clear that investors are really looking to some of these defensive ETFs, the not sexy, the boring, but always going to be used type of holdings, really taking advantage of some of this, again, slowing economic growth that we're seeing. And that's where we're really starting to see a lot of the gains lately. I think the biggest question for me right now is exactly how long will the defensive trade last? And what headlines do we think is really going to continue to remain tailwinds for some of these funds?
I have a slightly different take on those flows into some of those sectors. I just, to me, it's not really risk off when people are making sector bets. Risk off is maybe outflows or taking it out of a sector strategy, any sector, and going more boring broad market. But I mean, it is interesting to see the money moving into sectors that are traditionally considered more conservative. But to me, I still see a sector bet as a concentration, and a concentration is not necessarily somebody who just wants to relax and ride it out, unless that's a bet on one sector. So
Right, I would agree with that, but maybe just not 100% agree, because well, for one, I can't ever 100% agree with Jeff, right? But anyway, so
I should really
I would
put a fight bell for next time.
Oh yeah, but by the way, I forgot to say TLT is up over 20% since its low in October. But anyway, now back to utilities. But yeah, I wouldn't say it's risk off. I would say it's just lower risk. It's also, it's a defensive play. By the way, to plug up our articles, I mean, this is something I wrote on as well on Tuesday on XLU. It's a classic defensive play. So it may just be, okay, investors are thinking it's time to get a little bit more defensive, maybe not risk off, but lower risk. It's also a solid yield ETF, dividend yield, or dividend ETF. Not high dividends, so it's about 3%. So you're really not getting into that just because of the high income from it, but it's also an alternative to bonds, with if you want to be in equities and not take a lot of risk and get a little bit of yield on top of that, utilities are a good place to go. But I do agree with the overall point here is that it is somewhat cyclical. It's hard to imagine XLU getting another 20% or so over the next handful of months or over the next year.
I wrote about this a few weeks ago. Utilities was actually the worst performing sector earlier this year. Around February, XLU was down 5%, whereas the S&P was up 5%. Now you look and utilities are the best performing sector. So these things move around quite a bit. And like Ken said, I think the utilities play is more of an interest rate play. We saw interest rates, spike to their high earlier this year. That kind of pushed down utilities, and now we're seeing interest rates fall back and they're outperforming. Yeah, but there is a bit of a defensive tilt to that sector as well. So, there's so many different, variables, and people buy these for different reasons. But it is, pretty crazy to see utilities up 23%. And not a lot of people are even talking about it. Tech is getting all the attention still. But utilities, number one sector year to date.
I feel like a genius now because I was looking at utilities a couple of months ago, but you're right. I mean, everyone wants to pay attention to those tech darlings. I actually want to mention something else. I decided to just take a quick look at some buffered ETFs. Now, Jeff has written about buffered ETFs, I think more than anyone else here at ETF.com. But I just decided to take a look over at BUFR. That's a SIBO Vest fund of buffer ETFs. Just taking a look at some of the fund flows that we have here. I mean, year to date, they're not massive, 1.8 billion, but I mean, over half of that has come just from the last 3 months. As buffered ETFs, again, these are some ETFs that really kind of help you mitigate some of that risk that you could kind of be seeing, also taking more interest lately. But no, some of these defensive positions, I mean, I'll be surprised. Well, not surprised, but I think it'll be interesting to see where utilities close out for the end of the year if they end up beating broad market. I think that'll be a really interesting story. Maybe one of us will end up writing it if XLU ends up beating some of these broad market funds.
Right. No telling. This is an interesting year to put that, to say the least, and a lot more left in it with economy slowing, elections, and then September, October, some of the worst months of the year historically. So we'll see what happens.
And one last note here, just because, again, Sumit was mentioning some of those tech names. So some of those tech names really dominate the consumer discretionary sector. XLY, that's a consumer discretionary select sector spider fund. I just decided to pull up and see how consumer staples was really stacking up against consumer discretionary. So this is XLP versus XLY. And this is what I found absolutely insane for year-to-date performance. XLP, so again, that is consumer staples. Again, what some of us would call the really boring, not sexy kind of companies that you guys are interacting with on a day-to-day basis. Year-to-date performance up over 17%. Now compare that to XLY. That year-to-date performance is just over 3.5%, which is pretty insane. And again, as a part of that consumer discretionary, we do see companies like Amazon. Tesla is a huge part of that fund. And so I think, again, this just really speaks to, I don't want to call it the betrayal, but really how tech, while it was once the leader of the markets and kind of charging out ahead, really has been a kind of a big letdown in 2024, at least to come and end the year.
Absolutely. And I think we've seen some, concerns about NVIDIA, and, it's crazy to say concerns with the stock up, 150% year to date, but it's down, 20% off the highs. And just has the AI trade extended too far? Is it, too much too quickly? And then this whole debate about whether AI, is even worth the investments. All these, mega cap companies are spending billions upon billions. Are these investments going to pay off? Obviously, this is a debate that's not going to end anytime soon, but I think that kind of feeds into the narrative of, tech might be kind of toppy and all these other sectors might have their moment. So, we're seeing that kind of manifest itself in utilities. That's a sector that obviously outside of tech that's doing well. where we've seen at various points this year, small caps have caught a bid. The equal rated S&P 500 RSP has caught a bid. These are all kind of manifestations of the same thing where, people are thinking maybe the leaders of the market, the biggest of the big mega caps, maybe, they've had their run and we're going to see other, stocks take the lead from here on out. That kind of play has never really worked because the mega caps keep coming back and they keep outperforming. But maybe at some point, it'll work.
All right, well, that is our show. But before we go and say goodbye, for all of the retail investors and financial advisors that are listening, I'd like to invite you to participate in our newly released Global Investor Survey. Now, your responses are going to be released in an exclusive ETF report this fall. Check out ETF.com to participate. And that is all for this week's Exchange Traded Fridays. We hope you love the new format as much as we do. Be sure to subscribe, like, and follow us wherever you can get your podcasts. Now, we promise this is only the beginning, and we have so much in store for you in the future. So be sure to continue to tune in. You want to hear more debates between Jeff and Kent and myself. We're also going to be having expert guests and analysts join us in the future, but we'd also love to get our listeners involved. So be sure to tweet us on X at ETFcom or even write into us at editorial@etf.com. Be sure to tune in next Friday for the next episode.